Malaysia's 2026 budget sets a clear tone: fiscal discipline, targeted subsidies and a stronger push for accountability, without introducing new taxes. As the nation charts its path through global uncertainty, the focus now is on sustaining growth, broadening the revenue base and ensuring fairness across the system. What does this mean for businesses, taxpayers and the economy ahead? This is Money Matters. Hello there and good evening. You're tuned into TV3, where you can also stream on Tonton. I'm Muhammad Ahmad Hamdan, and today we'll dive into what Budget 2026 really means for taxpayers and businesses as the focus shifts toward compliance, efficiency and fairness. And joining us today is the Council Member of Chartered Tax Institute of Malaysia, CTIM, Harvinder Singh. Harvinder, thank you so much for taking the time to be with us here on Money Matters.
Thank you, Muhammad. It's great to be here.
Right, Harvinder, before we start with the first question, I would just like to get your reaction when the 2026 budget was unveiled by the Prime Minister yesterday. Was there anything in the budget that you find surprising, or is it largely within your expectation?
Well, Muhammad, I think there was really no surprises, I would say, because firstly, I think if you talk about new taxes, it was already expected that there will not be any. Over the last couple of years, we've seen sweeping changes, right, to the land tech landscape. And there's a need, as from that perspective, to have some sort of stability and consolidation. And in terms of ensuring sustainability and ensuring that the needs of the Rakyat are taken care of, I think we've seen various measures, as in the past, introduced and also expanded. So I think to a very large extent, pretty much as expected.
All right. Now, the Prime Minister projects Malaysia's economy to grow between 4% and 4.5% next year, despite global uncertainties. Yeah. From your perspective, what are the main drivers of this growth, and are we on the right path economically?
Well, Omar, I think in my view, I think this 4 to 4.5% growth does appear to be credible. Okay. On the basis that we've got, sustainable and sustained domestic, demand. There's this strong inflow of investments into the country, and on the back of the recovery of the some of the export sectors, the E&E sector, the electronics and electrical sector, the commodity sector, and under the new industrial master plan, plus under the Madani economic framework, public investment into structural upgrading, things like investment project, infrastructure projects, digitalization projects, green technology or green investment projects, which have potentially high multiplier effects, and the economic spiraling effect on the economy as well, which would lead to greater economic activities and spilling effects as well. So I think from that perspective, there are suitable grounds, sufficient grounds for us to feel positive about the potential for growth. But of course, we've got to be mindful of the global headwinds as well, particularly the
tariff situation in the US.
Tariff situation, the slowdown of, from the China perspective,
supply chain,
and geopolitical uncertainties as well, which could hinder, somewhat some of the upside potential.
Right.
But I would say overall, the policy that we have, Malaysia's policy, direction remains pragmatic. It is pro-growth, while at the same time mindful of fiscal sustainability as well.
Yeah, and the World Bank, I almost said the International Monetary Fund, the World Bank also just gave their thumbs up on Malaysia's economy recently, revised upward their projection of Malaysia's GDP.
Yes, I think we are chugging along quite quite adequately and quite positively. And so we've got to keep that momentum going and build on it.
Right. Yeah. Right. And with the 2026 budget trimmed from 421 billion to 419 billion for next year, operating spending barely rising and development funds contained.
Sure.
Is this fiscal discipline we should applaud, or is it a sign that Malaysia is heading for a slower growth?
Well, I think firstly, over the last few years, we've always marveled at how
big
the budget keeps growing, right? And of course, this, we talk about funds and all this. They're not unlimited resources.
Right.
So I think there has
so
to
we've
come
actually
time.
come to a point where we need to slow down a little bit.
Probably we need to slow down. We need to contain. We need to consolidate and move on from here in a little bit more, perhaps, sustainable and responsible manner. I'm not saying that we're not responsible in the past, but we cannot behave in such a way that we would expect an increase in the budget every year, coupled with the fact that we've got to manage the deficit as well, the budget deficit. As you know, under the Fiscal Responsibility Act,
the FRA,
there's a commitment to bring it down to 3% by 2028, if I'm not mistaken. So all this, I suppose, efforts to somehow slowly inch towards that reduction of 3% in about 3 years from now.
Right. Yeah, 3 years from now, the aim is to reduce the fiscal deficit to 3% against the GDP.
Yeah.
Do you think that is achievable?
I think based on the fact that we've got another about 2 years plus to get there, there's been this gradual reduction. And I think as long as, the expenditure, etc., discipline is there, and we are able to increase the revenues, right? Collection of the tax revenues, for example, is improved, and there's expenditure discipline is there. I think we should be able to get there.
So do you think that this target is realistic without introducing new taxes?
The fiscal target of 3.5 for 2026, you mean? Yeah, I would say, I would think it's realistic, but I have to always, caveat that with saying that it also depends on, as I mentioned just now, the revenue collection needs to improve. We need to manage the spending. There has to be, in terms of policy execution, needs to be very tight. We got to be very focused. And I think the key trade-off would be, in maintaining development spending on infrastructure and social programs and priorities without derailing consolidation. And as I mentioned, I think some of this, the development expenditure that will give rise to, spiraling effect on the economy, so that there is a recurrent need to recurrently spend on other subsectors. This, I think, has been part of the plan.
Right.
To allow that to happen.
Now, Havind, we want to dive deeper into an environment of revenue without new taxes. But hold that thought, because we're going to go for a quick break right now.
Sure. Thank you.
To our viewers, don't go away, because Money Matters will be back shortly. Welcome back to Money Matters. We're speaking with Council Member of Chartered Tax Institute of Malaysia, CTIM, Harvinder Singh, with me right here in the studio. Harvinder, let's talk about revenue without new taxes. The government plans to boost revenue through better governance and enforcement rather than new taxes. Is this a sustainable approach in the long term, in the future?
Actually, I think at this stage, at this point in time, and as we mentioned earlier, there have been some sweeping changes in the tax landscape the last couple of years. There have been new taxes in the form of capital gains tax introduced starting from last year.
Luxury taxes,
global minimum tax, which affects certain categories of taxpayers. And of course, not to forget the rollout of the e-invoicing system as well, which basically has affected many businesses, many taxpayers. So I think any further radical shift, would basically disrupt a lot of the planning and the the investor confidence. And so doing business at the moment, I think it's important to have some sort of stability coming in. And I would say that the low-hanging fruits as far as tax collections are concerned, these have already been introduced. If you talk about e-invoicing, it's there. With e-invoicing in place, it's expected that once it's fully enforced, fully in place, fully implemented, there would be quite a significant increase in the revenue. We've also had the expansion of the SST, taxes as well. So I think quite a bit of the impact of this in a positive way, as in increased revenues, should kick in 2026. So that, I think, is probably the reasoning behind it. But of course, this strategy, it cannot be for long term, because if we talk about
it is what we need right now against the current backdrop.
Correct, at the moment. And, so there's going to be a need for increased governance and administrative efficiency. But these things tend to plateau, after a few years, right? So in the long term, in the long run, obviously Malaysia needs to broaden its tax base, perhaps through consumption taxes, and also, the environmental taxes that are probably going to be the order of the day as we move forward to ensure there's revenue resilience in the future as well.
We actually want to talk on that consumption tax later on, but you mentioned the impact on businesses and also investor confidence. Now, do you think the 2026 budget strikes the right balance between fiscal discipline and private sector confidence, especially in encouraging business and expansion and foreign investment in the country?
Yeah, and I would say yes. I think it appears to find that balance between, there's fiscal prudence without overt austerity, not going overboard. There is money for spending as well to make sure economic activity takes place when money changes hands. So spending needs to come in, and at the same time there are targeted incentives to boost investment and innovation as well. And I think predictable financial management helps maintain investor confidence, as you would imagine. But policy clarity and consistency, that's going to be key as well, right? And particularly in tax and regulatory frameworks, it remains essential. It's essential to have that in place to basically maintain the confidence.
And e-invoicing will be mandatory in 2026. How transformative is this move for Malaysia's tax administration? And what should businesses, especially SMEs, start preparing for?
Well, e-invoicing is, I would say, what we call a game changer when it comes to the...
That's a nice way of putting it, but
yeah,
go on.
It is, because it is actually going to help boost compliance to a large extent. It may appear to be complicated, but I think the initial trepidation of most businesses, right, in terms of the cost to be incurred in putting in the systems and all that,
the mechanisms
and all that. Actually, at this stage, I would like, and this information needs to be disseminated to as many businesses out there, as many SMEs as possible, that it's not going to exactly, not really going to cost you an arm and a leg to invest in these things. They're very affordable gadgets, they're very affordable apps, etc., that allow the sort of seamless usage of e-invoicing as well. And, there are QR codes that have been developed by the IRB as well, where, if you can use JomPay at the fresh, the wet market to buy your stuff, your goods and all that. This is not very different from that. Basically, it's just a question of scanning and the information of the taxpayers. So eventually, everybody is supposed to have a TIN, right? So your details are going to be there. It's going to be scanned. It's going to be captured. It's going to be seamless. Just like I go to the supermarket and I get an invoice now. Similarly, that e-invoice can be generated within So all that are things that I think the facilitation of transactions and all that should be quite seamless on a moving forward basis. There is this misconception, perhaps.
I think as with anything.
Yes, as with anything as well. So it's really a question of going out there and explaining this and getting businesses to understand the realities behind it. It's important for SMEs, of course, right, to get on board, to get the relevant infrastructure in, get the gadgets, seek assistance where you need to, but do not dismiss it as something that's complicated and difficult, because really it should not be, right? And so with these systems in place, with proper reporting, right, I think the payoff for the SMEs would be long-term efficiency as well, and easier access to financing, right, due to the fact that you've got improved financial records.
But do you think we're doing the right thing? I mean, are we doing good at communicating this thing to the SMEs especially? Because we hear grouses from the SMEs about the e-invoicing.
Yeah, I feel the grouses are getting lesser, or the noise is getting lesser. So it is actually, it's a good thing that it's being rolled out in phases, so that those that have the capabilities and the financial resources to perhaps start it, initiate the large taxpayers, they've gone through the period of trepidation and anxiety and putting it in place. And along the way, apps have been developed. There are a lot of software providers that have come on board as well. So things have started becoming a lot more affordable and easier to use, user-friendly. So I think by the time we talk about 2026, it's at the end of 2026 that e-invoicing is supposed to be implemented fully.
Right, so we practically have about a full year before it is fully implemented.
And of course, from the tax authorities, the government's perspective, they also need to have sufficient leniency, right, for initial onboarding, soft lending, and not being overly, strict with the penalties. Right. There's a lot of leeway, I think, that's being afforded and accorded by the authorities as well.
That's good.
So I think there's a need for the authorities again to also adjust mid-course, right? If there's a need to maybe extend it a little bit further. See, currently there's an exemption if you are not having more than 500,000 turnover.
Right. There's a threshold.
Yeah, there's a threshold there. But the way I look at it, it's a question of time before everybody will be basically required to have invoicing. The idea behind this is also to get the shadow economy right onto the system, right? So e-invoicing will be very critical for that.
Right. Harvinder, we want to explore targeted subsidies and tax fairness, but hold that thought because we're going to go for another quick break.
Sure. Thank you.
Once again, to our viewers, don't go away because Money Matters will be back shortly. Thank you for staying with us. Council Member of Chartered Tax Institute of Malaysia, CTIM, Harvinder Singh, with me right here in the studio. Harvinder, the government continues with targeted subsidies instead of blanket assistance. How does this align with broader goal of fairness and efficiency in fiscal management?
Well, I think it goes, perfectly in line with that, that idea, because by channeling support to lower income households and productive sectors, the government can contain spending while ensuring and improving equity as well. But obviously, the implementation must be transparent and data-driven to maintain public trust, right? And I think, as mentioned, in the speech by the PM as well, the overall subsidy, savings from the subsidy rationalization is expected to be about 15.5 billion annually. And so this can be channeled to riot-focused initiatives, enhancing social welfare, increasing allocations to ease the cost of living for taxpayers as well, and investing in better infrastructure that benefits most Malaysians, all Malaysians. And just as an added point I would like to make, talking about e-invoicing.
Okay, sure.
Right? Because with e-invoicing in place, the data of taxpayers is going to be with the IRB.
Okay.
So, if you talk about currently with the RON 95, you got to use the
My card.
My card. If you go to a Kedai Runcit in future, and if there's supposed to be some rationalization of whatever other goods as well, I think e-invoicing will play quite an important role in allowing that to happen as well. It will allow for data messaging, data analytics, etc. in place. So I think this whole idea of targeted subsidies can be really supported by the e-invoicing system in place. So e-invoicing has got amazing, benefits for the country.
Right.
It's very critical.
And
Malaysia.
also, with countries in the region, in the ASEAN region especially, offering aggressive tax incentives, do you think Malaysia's current framework is still attractive enough for foreign investors?
Yeah, as you know, I think the last few years the focus has been on removing blanket exemptions and having what we call performance-based, incentives that are coming in. There are a number of reasons for this. Firstly, Malaysia has been relying on incentives for a very long time to attract investments into the country. But increasingly, the OECD, the G20 countries, the European Union, they keep saying that you got to this artificial means of attracting investments, right? So you got to look at transparency, you look at creating a better business environment for investments to come in, because most of these foreign countries, these Western countries, do not have such incentives, right? There has to be a level playing ground in that sense. That's one. Secondly, we've had the introduction of global minimum tax, right? Which means that there has to be a minimum tax of 15%. So if you talk about attracting an investment from a Japanese company and you give them a blanket exemption, and that company is the sole representative of the Japanese parent company, this exemption, 100% exemption, is of actually not much relevance anymore, because they have to pay a 15% tax with the global minimum tax coming in. So it's also in line with that, that if we want to. But we also find that it's still important for us to attract investments through incentives. So the idea is to have this outcome-based approach, right? If the foreign party is willing to invest and they're attracted by these incentives, then, just as an example, in the past, if you get pioneer status, 100% exemption, for example, for 5 years, it doesn't matter whether your revenue is growing or your profits are growing or going down, you get exemption on the entire amount. But here the idea is to increase productivity, which will be reflected by the increased profitability that you have. So on a year-by-year basis, the incremental profit that you show an increase on is the one that you probably get an exemption.
Right.
While the base amount is still taxable. So it means that there is some tax to be paid and you don't really have this issue of the tax adjustment to 15% perhaps, and you're also rewarded for increased productivity. So the idea is, instead of static tax holidays or allowances, the government rewards for actual contribution, right, to national goals and increase in productivity. And if you talk about the other countries, well, they'll have to grapple with these global issues themselves as well. So these incentive regimes for the other countries as well, it's a question of time when perhaps they'll have to amend and they'll have to adjust accordingly as well. So what Malaysia is doing is we are basically, it's at the behest of the OECD, etc., that we are complying with this. So it's in line with what we call global best practices.
Right. Hamida, I actually have a lot more questions to ask, but unfortunately, we're at the end of the program.
Right.
Just very, very quickly before we end the program, I just want to ask your opinion about, you said we needed a better consumption tax.
Yeah.
In my mind, GST, when do you think is the right time to reintroduce GST? Very, very quickly before we wrap up the show.
I think, again, at this stage, there is this reluctance for a number of reasons. If we go back to the statement by the Prime Minister last year before the budget announcement, they're saying that we will put it on hold until the minimum wages reach the level of 3,500 to 4,000. That's going to be probably way down the track.
That's a long way to go.
Yeah, but there might be a need to perhaps revisit this as time goes by.
Okay.
So I think the timing would depend on inflation stability and things like public readiness. And potentially maybe after 2027, right? Once e-invoicing is fully operational and to support compliance and transparency, and e-invoicing has been designed to even accommodate GST as well.
Okay.
Right. So probably that would be the opportune time to introduce GST.
Okay. Right. Well, Harvinder Singh, thank you so much for taking the time to be with us here on Money Matters. We really appreciate your insights on this program.
Thank you so much for having me here.
Okay.
I've enjoyed myself. Thank you.
Great. Now, for the past half an hour, you've been with us here on Money Matters. If you missed any part of today's show, you can always catch it up on Tonton. I'm Muhammad Hamdan. Thanks for watching and have a great weekend.